much for joining us today. Look, we've been talking a lot on Yahoo Finance about the rotation that we're seeing out of tech and into some areas like small caps. What are you bullish on, and what do you think is undervalued at this point?
Well, good to talk to you, Alexandra. I think investors right now, first off, should make sure that they are not going to allow their emotions to become their portfolio's worst enemy. Yes, we are seeing a rotation away from the tech stocks, these mega caps that had been leading the market over the last 2 years. But I think that's actually quite natural and necessary. Now we are rotating into what I call the also rans. And these are the groups that did not do well when tech was doing so well. But because of this participation expansion, that's actually positive for equities because now more and more of the constituents within the broader market are participating in the advance. So I would say to investors, if you feel like you have to do something, simply hit the rebalance button on your 401k. Take a look at all of the stocks and ETFs that you have to see what exposure you do have to technology. In the S&P 500, it's a little more than 33%. On an equal weighted basis, it's about half that. So just make sure you don't have way more exposure to tech stocks than you have in the broader market.
So looking more broadly ahead here, Sam, do you think that this pullback that we're seeing in tech, could that signal a potential correction to come down the line, or at least more volatility in the short term? And if so, how can investors protect themselves?
Yes, I do think that we're going to see more volatility. We are in traditionally the challenging third quarter. That is the worst of the 4 quarters on average in terms of price change and volatility. And September is the worst month of the year on average, falling more frequently than it rises. But I like to say that forewarned is forearmed. If you know that we are heading into a rough patch, then you're likely to sit on your hands and do nothing. What I remind investors is that we have had 65 pullbacks. Those are declines of 5 to 10% since World War II. Amazingly, it's only taken a month and a half on average to get back to break even from such declines. We've had 25 corrections, declines of 10 to 20%. And amazingly, it's only taken 4 months to get back to break even. So by the time you worked yourself up into a frenzy and convinced your advisor to lighten up on equities, the market is probably already on its way back to full recovery.
So the long-term play there for investors. And when you think about tech, should you avoid it at this point? Are you too late to get into it because of the recent rally that we've had? Or do you think that this is still a viable sector for investors that are just getting into the game?
We do believe that tech is a viable sector. And actually, what you could do is just wait for some softness in prices in the weeks ahead and then use that as a better buying opportunity. And the reason that we still like it longer term is because of the earnings growth that we see ahead. For 2025, we are looking for a little less than 15% growth for the overall market, but more than 20% growth for the technology sector, and a similar kind of outperformance in terms of earnings growth in 2026. And come the latter part of this year, a lot of the analysts will be focusing on 2026 expectations, and most of the decisions to buy or sell will be based on those forecasts.
And we have Netflix kicking off some of those big tech earnings later this afternoon. And I want to talk a little bit about the jobless claims data, because we're seeing a continuation of this softness in the labor market. How do you think this plays into the narrative for the Fed that they could potentially be cutting rates?
Well, I think it adds, bolsters the conviction that investors have had over the last week and a half that triggered this rotation into the also rans, the interest sensitives, the mid and small cap stocks, because there is an increased likelihood that the Fed will be cutting interest rates starting in September. And let's remember that in every election year since 1990, except for 2012, the Fed has either raised or lowered interest rates before the election. So given the opportunity to prove that they are independent, they will do so. And I think lower rates will continue to support and propel equity prices.
A lot to look forward to in the next coming months. Thank you so much, Sam Stovall, CFRA Research Chief Investment Strategist.